Thank you, Stanford. Good afternoon, everyone. On behalf of Spark Capital, I welcome you to the 3Q FY19 earnings call of Karur Vysya Bank. We have with us today the management team of KVB, represented by the MD and CEO, Mr. Seshadri, President and COO, Mr. Natarajan, General Manager and CFO, Mr. Sivarama Prasad, and Company Secretary, Mr. Srinivasa Rao. I now request Mr. Seshadri to take us through the highlights of the quarter gone by, after which we will open the floor for questions. Over to you, sir.
Thank you very much, Abhinesh. Good afternoon, everybody. Thank you very much for joining us on this call today. I thought initially that we would go through, all the significant things that had happened during the quarter and then address the NPA-related issues that I'm sure you guys, all of you have questions on. But on on some introspection, I came to the conclusion that perhaps it is best to address the elephant in the room, talk about NPA first, and then go out and address the other items. So during the quarter, in the investor presentation on page 35, you will see that we had a net NPA addition of 349 crores, comprised of 86 crores from commercial, 246 crores from corporate, 8 crores from agri, and 9 crores from retail. You'll also recall that, consistently we've been giving the message that we would like to build a portfolio where the annualized NPA accretion is roughly 150 basis points. Net accretion on an annualized basis is 150 basis points, is the kind of portfolio that we would like to build going forward. That amounts to roughly, on a portfolio size of 50,000 crores, roughly 750 crores or thereabouts on an annualized basis of net slippage. You'd also remember that in November of 2017, we had indicated to you that there was 1,200 crores of watch list, of which 164 remained unutilized. So during this quarter, essentially CBG, which is our corporate business, our agri business, and our retail business, the NPAs came in as planned. The sum total of those NPAs are roughly 103 crores, leaving a gap to the planned NPA that we would have had as per normal of roughly 80 to 85 crores, right? So if our 150 basis points had held good, we would have had about approximately 180 crores or thereabouts of NPA. 103 comes through these three businesses, 80 is left out, right? Now, during the quarter, we also had, NPA on account of a large non-bank finance company, which is systemically important, amounting to 314 crores, that was recognized as NPA. In addition, 130 crores of what was on the watch list became NPA. So that amounts to 444 crores. And one restructured asset, if you recall, we used to have, we've been working down our restructured assets. One of the chunky restructured assets that was still on our balance sheet, which is amounting to approximately 40 crores, which you had full visibility to, also became an NPA during the quarter. So adding all three of these, which are items that were fully known to the marketplace, we get a number of 444 plus 40, that is 484, plus the fact that we had indicated to the marketplace that our NPA on an annualized basis would be roughly 150 basis points. You have to add the other 80. That brings us to roughly 570 crores. Against that, for our corporate book, our NPA is roughly 680 crores. Net of certain collection items that we would have accounted for in any case. So therefore, we had, incremental NPAs amounting to 100 crores that were outside of what the market would have expected. But given the fact that we are running a large book, and given the fact that we made these predictions 14 months back, I think we are within the margin of error that could be expected under the circumstances. I'd also like to indicate that during this quarter, we took credit provisions to the extent of 432 crores, which is 7 crores above the operating profit for the quarter. This included a 50% provision against this systemically important non-bank finance company, of which there has been significant, discussions both in the papers and outside. When we look at the 5 quarters forward, our belief is that our CIG, which is the Corporate and Institutional Group book, we should expect NPAs to the extent of approximately 750 crores, slippages of 750 crores in the next 5 quarters. I repeat, this is a forward-looking statement. This is the best guess estimate that we have at this point in time. And another 1,000 crores or thereabout from our commercial book, slippages, not net slippage, gross slippages. And we expect another 100 crores or thereabout for our retail and agri book. So net slippages over the next 5 quarters, in our expectation, is 1,850 crores, which will be offset by 700 recoveries. So our current expectation, and I repeat the word current, on the basis of information available today and on the basis of all the analysis that we can do at this point in time, our current expectation is that over the next 5 quarters, our net NPA accretion would be roughly 1,100 crores. Now, given the fact that we do not have a crystal ball that is 100% accurate, and given the fact that we were out of our estimation to the extent of 100 crores for this quarter, I am, as a matter of ample caution, adding 200 crores to the 1,100 crores that I just told you. So our expectation is that over the next 5 quarters, our net NPA accretion will be of the order of magnitude of 1,300 crores. It is my expectation that some of these 1,300 crores will be front-loaded, i.e., this will be like a decaying curve. It will reduce over time. And the 1,300 crores that we are talking about is not very far away from the 1.5% net NPA accretion that we've been talking to you about. Our expectation was that we would reach this a little sooner than we are likely to. But having said that, we think that we are within striking distance of hitting that number as we go forward. I will now try and revert back to whatever it is that we've been trying to work on over the last quarter or so. Essentially, we're working on 4 broad themes. The first theme is to improve efficiencies and to build competitive advantage for ourselves. In that regard, we've, as you've seen, launched, I believe, the most comprehensive digital banking initiative in the banking industry as of today. It is now fully embedded in our system. Our people are using it. It is generating very substantial volumes of loan applications. We generated 42,000 loan applications last quarter, which is a number that we've never generated in the past. And numbers are still increasing, and our expectation is that we will be able to use this tool to grow business volumes on the retail and on the commercial side very significantly as we go forward. It provides to us a new method of doing business. It provides a competitive advantage that will take our competitors a little bit of time to replicate. Similarly, on the commercial side, our system went live, as you're aware, September end. October to December was the first full quarter of usage for new to bank. And the good news is that it's now almost fully embedded. Our folks have gotten used to it, and we are seeing incremental traction on that platform day after day. Our new processes, we've introduced a whole set of new processes that are market benchmarked, that will ensure that, the products and services that we're offering to our customers are not only competitive, but are delivered in a manner that the customer wants it. The second key area of focus for us was to improve risk management. As you're aware, we had hired a chief risk officer about a year or so ago. We continue to augment the team on the risk management side. We have also undertaken a risk limitation exercise on the corporate bank front. It is something that I will talk about later. Essentially, we are limiting the tickets that we are writing on corporate, which is one of the reasons that you're seeing that our corporate book has shrunk sequentially and year on year to the extent of 6%. We've changed the risk architecture in the company. We moved from a decentralized risk acceptance process to a centralized risk acceptance process. And we've also ensured that we've put risk specialists in our divisional offices where credit-related decisions were taken hitherto without the presence of a risk officer. So there's been a hell of a lot of work on that front. As I've been telling you, we've implemented a whole host of new scorecards. We're updating a series of new scorecards as we speak. We are using external benchmarks more aggressively, like CMR, external rating methodologies, et cetera, more aggressively to ensure that the book, the quality of the book improves substantially. Most of these initiatives have already been implemented. Some are ongoing. And we are seeing that where automated decisioning tools have been implemented, the through-the-door population is behaving significantly better than historic vintages at the same time, let's say last quarter of 2017 or early 2018, the first quarter of 2018 versus the first quarter of 2017, 9 months out, the performance of the newer vintages are much, much better. This is more visible where the scorecards were implemented early, a little less visible where judgmental underwriting continued, but we are moving to an area where scorecards are more, used more, and as a consequence, we think that the portfolio that will be judgmentally underwritten, especially on the smaller ticket, will reduce over a period of time. The third area of focus for us has been operational control. We are, as an organization, we've operated in a completely decentralized manner over these 102 years that we've been in existence. We've been strengthening the operational backbone of the company by centralization. So we've, over the last, 2 or 3 quarters, we've been focusing on studying the activities, the operational activities that have been done in the company, where they are being done, and trying to move them into a centralized location where they can be done in a controlled manner. In that regard, the branch operations centralization is an important initiative that we are currently undertaking. We have already centralized a few of the activities that the branches used to do, associated with, customer demographics as well as management of limits on customer accounts. These were centralized last quarter and the quarter prior to that, if I'm not mistaken. We are undergoing currently a complete analysis of all our branch activities so that we can centralize activities that are best done in a back office location and free up time in the branches for more sales-related activities. We've also invested a great deal of money in AML and KYC systems upgrade so that to ensure that, we are appropriately set up to ensure that RBI's and other regulatory requirements are met completely. The fourth pillar of what we are trying to do is to ensure that we grow profitably. We're doing a bunch of things on this front. We are enhancing our product suite. You will notice in the deck that our credit card, commercial credit card, has gone live. We test launched it in December. We are at the process of ensuring that, everything works as advertised. And we should be going for a commercial launch later part of this month. And we are expecting that we will book approximately 10,000 cards during the rest of the quarter. It's a tight ask, but we think we can do it. We've implemented risk-based pricing to ensure that the risk asset that comes on board is appropriately priced. We are seeing the results of that flowing through. A consequence of the, risk-based pricing is that our net interest margin has grown in this quarter against the prior quarter, in spite of the fact that gross slippages were significantly higher than the prior quarter, which means that in spite of the fact that we've had significant interest reversals, our NIM continued to grow, which is indicative of the fact that we do have pricing power, and that is being demonstrated in the NIM that is flowing through. We've demonstrated, very tight control on costs. I'm sure you've seen the deck on a year-on-year basis, in spite of the very significant investments that we've made on the technology platform, on the new hires, and so on and so forth. Our costs are tightly controlled. The growth, which appears on the face of it to be 13%, is effectively on account of retirement benefits for which we had to make provisions on account of interest rates moving in our direction. If I may just step a moment back into the second point, which was the risk management point, I forgot to mention that we've been working towards ensuring that our company is ready to move into Ind AS as quickly as possible with the minimum of disruption. And one of the items that we had to deal with was the treasury book. The treasury book, in keeping with the way most traditional Indian banks have dealt with the treasury, we had large durations or long duration papers sitting both in held to maturity as well as in available for sale. Over the last 2 or 3 quarters, we've been working very hard to reduce duration on the treasury. I'm happy to report to you that duration on the available for sale securities is now down to 1.82 years, which was over 3 years just 2 quarters ago. And the duration on our held to maturity book is down to 4.05 years from 4.5 2 quarters ago. And if you go back further, you will find that there is even more reduction. So we've reduced volatility on the treasury book. We've swapped out the 10-year duration assets that we had with 4 or 5 year duration assets over the last quarter and the quarter prior to that. And I'm very happy to note that interest rates have moved in our direction because the yield curve, instead of being inverted at about 3 to 4 years, has now become straight, and which has left us significantly in the money on those assets. So in summary, these are the 4 broad themes that we've been working on, and I think that if we were to do this properly, we would be in a position to get to where we want to get to. I just want to spend a minute more talking about our expenses. Expenses are tightly under control, as I said, and in order to keep the expenses so, we've shut 8 branches so far. We are down now to 782 from a peak of 790. We've also shut a bunch of ATMs on account of the fact that, those ATMs were not really making us money. And in the context of, the requirement for significant upgrades on those ATMs for security reasons, we felt that it was better for us to shut them down. Just to spend a minute or two on the liability profile of this institution, I'm happy to report that over the period, our average balances have grown roughly. Our average balances have grown 12% on savings, 7% on demand. So on an amalgamated basis for CASA, we've grown 10%, which is a reasonable growth over the period. We'd have obviously liked it to be a little higher, but having said that, we do have a very granular book, which we think is going to hold us in good stead as we go forward. We've deliberately kept the growth of time deposits down because we do have challenges in putting out the money, and therefore, in the absence of greater, visibility on growth, we had moderated the growth of our time deposits. But we are confident enough to say that should we need the money, we should be able to generate it. With respect to the asset business, you'll notice that it's a story of 2 worlds. The first point is that our retail business is growing very, very nicely. Year on year, we've grown 25%. It does include, however, IBPCs to the extent of 500 crores, but even ex that, the growth is nice, granular, high-quality growth. Agriculture and commercial have grown 7% and 9% each. Agriculture, this is a part of the season where we should get some growth. Our control screens, both on agriculture and on commercial, have been tightened very considerably, so we are ensuring that we get higher quality loans on board. On the corporate side, as I said, we've been tightening our expectations as far as the quality of the risk, and as a consequence, we've wound down a portion of the portfolio. We've also sold some of the assets, which is the difference between the 680 I talked about and the net number that is showing in agriculture on the NPA. Sorry, not agriculture, on the corporate side. So that's pretty much it. I'm happy to answer any questions you may have. I think we are feeling reasonably comfortable with where we are going. We do have some challenges left. I do not believe that challenges are all over. You would have noticed that our gross NPA is 8.49 and net NPA is 4.99. That is an area of challenge that we have to address. And what we intend to do is that over the next 5 or 6 quarters, we intend to continue to provide aggressively. We think that the regulatory requirement for provisioning will come off as our NPA numbers moderate towards the level that I'm talking about. But we will continue to provide more aggressively, thereby catching up with provisions and reaching the 60% mark, which I think is adequate given the nature of our portfolio. So that's pretty much it from my side. I thank you once again for being here with me. I'm very happy to answer any questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Dhaval Gada from DSP Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. Just a couple of questions. First, sir, I got a little confused with the comment you made on the 5-quarter guidance on gross and net slippages. If you could just repeat the gross numbers across the segments that you talked about, that would be very useful, sir.
Thank you. So I said that we expect, and this is an expectation looking 5 quarters ahead.
Sure.
So we are being a little, circumspect here. The corporate slippage we expect 750 crores, which is only to be expected given the quantum of NPA accretion that has happened on the corporate side.
Right.
On the commercial side, we expect approximately 1,000 crores.
Okay.
And these are gross slippages.
Yeah,
and then approximately 100 crores for both retail and agri put together. Okay?
Okay. So 100 each, right?
No, 100 in total.
Total, okay.
So we come to 1,850 crores.
Okay.
We expect 750 crores of recoveries.
Okay.
Which brings it to 1,100 crores. But given the fact that, I don't have a perfect, what should I call it, perfect crystal ball to look at the future, I'm adding another 200 crores.
Okay, understood.
Buffers to get 1,300 crores. Okay?
Okay. Now I got it. Okay, so the maximum you expect into FY20, by the end of FY20, for the next 5 quarters would be 1,300 crores, maximum.
That is right.
Okay, understood. And, right. And sir, the second question was around this quarter. What was the write-off amount? If you could just provide that. So you've given the reduction amount. If you could also give the write-offs during the quarter.
The write-off that we did was to the extent of 434 crores.
And how much was it last quarter, sir? Just in case you have it handy.
Yes. These were, sorry, what did you ask, Dhaval? I'm sorry, we just had a...
No, I was just saying, Sorry, I was just saying that how much was it last quarter in case you have that number handy? I have it 0. I just wanted to double check if.
We didn't do any write-off last quarter. This quarter we've done 434. This is essentially a sale. This is a sale to an ARC. Okay?
Okay, understood.
Cash sale, not on not with an SR. Yeah?
Right. Sir, just last question on, normally you end up giving a ROA guidance. Given the quantum of credit cost that is likely to come in the next 5 quarters as you move close to 60% provision coverage, what's your expectation on return on asset? And if you could also sort of end by sort of tying that with the capital requirement, while you're not growing, but the accretion probably will not be as sizable. So just if you could tie the 2 bits. Thanks.
Thank you, Dhaval. So basically, to address that question, one needs to look at what the 5-quarter pre-provisioning operating profit would be. Pre-provisioning operating profit at current run rate would be in the neighborhood, I presume, of in the neighborhood, 2,100, 2,200 crores at the very least, I would think. Assuming it is 2,100 crores, and my provisioning rates on this net 1,300 crores, let us say, is 70%. 700 crores. I will have to provide, or 75%. Let's say I provide 1,000 crores, okay, out of the 1,300 crores that goes through. Then I am left with that 1,000 crores or so or thereabout. Let's say I even provide a little bit more. We provide 1,300 crores just to ensure that we catch up. I haven't done the math in my head.
Sure.
But you could say that I'm providing 350 crores a month a quarter. That will give me 1,650 crores or so. 350 into 5. Yeah, 1,750. 1,750.
Right.
If we do 1,750 crores, then we still have pre-provisioning operating profit of 2,200 crores. We are then left with 450 crores.
Understood.
So it's a question of how much we need to do, and we will play the game as we go forward. But we intend to provide more than is expected. You've seen that over the last 5 quarters, we've increased our provision coverage ratio, except for this quarter.
Correct. Yes.
Even in this quarter, we've provided very aggressively to ensure that we have 50% coverage on the one name that most of you would be interested in.
Correct. Okay. No, this is useful, sir. Thanks and all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Prashant Poddar from ADIA. Please go ahead.
Good evening, gentlemen. Sir, I'm actually, I want to talk about the slippages number for next 5 quarters you gave. I understand this is gross slippage, but in commercial loan, 1,000 crore would essentially mean about 7-8% kind of gross slippage. Is it that bad a portfolio?
Mr. Poddar, I think it's a very good question that you ask. Historically, the portfolio has been, it is a small ticket portfolio that has been dealt with in a particular manner, in the sense that we've told customers that it is okay for them to pay in 30 days or 60 days as long as they pay us before the 90th day. And when under these conditions, what happens is one slip makes them go into NPA. I mean, if they are persistently on 60th day and they miss one cycle, they become NPA. So we've got elevated SMA2s, and this is in common with most other banks of this nature, because historically, being in SMA2 was not seen as something wrong. We've been trying to tell people that is unacceptable. We've been communicating to them saying that, we expect you to be current on all your obligations. We've been incentivizing them to be current on all their obligations. But given the fact that we've got elevated SMA2s, we expect the, gross slippage to be high. However, our expectation is that, since these people are reasonably good businessmen, they are small businessmen where business is run by the owner himself, the expectation is that they will come back, if not immediately, within a month or 2, which is why 1,000 crores of gross slippage is the number that I have averred to.
So I understand that, sir. And then the other, so when you say recoveries of 750, this is inclusive of the reversals which will happen from this portfolio.
Correct. That's true.
And if you were to really look at the net slippage in this portfolio, is it fair to assume that it will be close to 500 crores only?
Net slippage on this portfolio, yes, it would be in that neighborhood, yes. Maybe a little touch higher, maybe at 600 crores or thereabouts. Yeah.
Sorry, I didn't get that point.
I'm saying a touch higher. We were expecting approximately, at this current juncture, being conservative, we are saying about 600 would be a number that I'm hazarding. If you recall, I don't know if you were on this conference call after the first quarter. After the first quarter, we had elevated NPAs during the first quarter on the commercial side. It came in at 241 crores. And everybody was worried about the commercial portfolio. And they asked me, what do you think is going to happen to this commercial portfolio? And our answer to them was that we had done a flow model. We built a flow model. We had studied the flows. And assuming that the flow rate was the flow rate as of the first quarter, the NPA expectation for the entire year would be 700 crores incremental. That is the net NPA. And assuming that, the previous 9 months flow rate held, then it would be in the neighborhood of approximately between 400 and 500 crores. The reason why we, did this analysis, and this was trying to sort of back up our own view, that historically the NPAs in this portfolio seem to maximum happen in the first quarter, and then they sort of tend to retrace over the next 3 quarters. Now, under the current circumstances, there is reasonable tightness on the SME side. And, however, our portfolio has behaved since then. Our net NPA accretion in the first quarter was 241 crores. Next quarter was 98, if I'm not mistaken. 98. And subsequently, this quarter is 86. So, it's come in much lower than what we had predicted initially. So the prediction that we are making now is on the basis of information that is available and what can be seen, the movements that we can see on the ground. So slippage of 1,000 crores is something that we would expect, where on a net basis, including corporate, we will get approximately 1,100 left out. I think on the commercial side, it will be probably fair to say 500 is a reasonable number. There will be an error margin in that. Plus minus 15% is something that you can expect. So it could be 425 to 575 is a number that you can have.
The other bit is on the corporate itself. After the kind of slippages which the portfolio has seen, not only for you but for any other large corporate bank, now even SBI, even public sector banks are looking for negative slippages incrementally, and you're talking about close to 4-5% gross slippage, even in this portfolio in the subsequent year. Either it is too conservative or it essentially means that the portfolio is still bad.
I think it's a good question. Our portfolio in terms of gross slippages are arguably, I tend to agree with you that we've had very large slippages both in recent times and in the past. And the portfolio performance has been anything but good. But having said that, the portfolio is on our books, some of it needs to flow through. We are unfortunately, unlike the PSU banks, lenders in entities which are not part of the NCLT settlements that have taken place so far. So consequently, the recoveries that you've been seeing for some of these entities has not been seen by us. So we have to go through the long grind of going through the legal process, and that it sets us apart from the rest of the PSU banks.
So that is the bit on recoveries, which also, so the larger names, not getting addressed outside is understandable, but these smaller loans, average ticket size of 34 crores, and 72% of your current book being less than 100 crores. SMA 1 and 2 in your corporate book being only 2.82%. If SMA 1 and 2 is only 2.8% of the loan book, expecting a slippage of 5%, I mean, actually, I can't understand this number. Either it is too ad hoc, it is too, what should I say, it is too guesstimated a number, or it is too conservative, because if your SMA 1 and 2, all of it slips as well at this point of time. We shouldn't see that kind of slippage as you're talking about. Why I'm discussing this number alone is because, as the previous participant also asked, your PPOP isn't high enough to help you increase your coverage ratios to a level which most banks will have post recoveries, post everything financial year 20 end. Even some of the PSU banks will have their net NPAs close to 2%, which we will not have if we just look at our PPOPs and the kind of slippages, even incrementally you're talking about.
No, I think
our understanding from your previous conversations has been that the portfolio that's remaining on the book, at least, is pretty high quality. If I don't have the data on your ratings of corporate book here, but in the previous presentations you have shared that, and that looks to be very, very high. And in that perspective, these numbers look too conservative, or probably has been a reassessment of the corporate book altogether.
No, I think you make a valid point. I don't think we've articulated that the book, articulated anything about the health of the corporate book so far. Our corporate book, our expectation was that because we had large slippages, going forward, whatever remained would behave. We have visibility to roughly half the number that I just told you, that we think that those are bad, and that will flow through, which is amounting to 375, 400 crores or thereabouts. We don't have visibility to the rest of the numbers. You're right. There is a degree of estimation that one has to do, because we are speaking now 15 months out, and unfortunately, things change. The good news is that we don't have exposure to many of the names that are being debated today, where there is discussion as to the viability of certain entities, which appears in the newspaper very often. Most of them we don't have any exposure to. But it's very difficult for us to definitively name the entities that are going to go bad between now and 5 quarters out. So therefore, the visibility that we have, as you rightly mentioned, is to about half of that. The other half is a guess estimate on the basis of other names. Those may not flow, or those may. So we perhaps have become a little bit more conservative than we were the first time around when we gave an estimate of 1,200 crores on the corporate book. And we were pretty much bang on, actually. So in this case, perhaps we are a little bit more conservative than we should be. Having said that, that's the best number that I can provide at this point.
So very quickly, last question from my side. On advances growth, can you give us some indication of the 3 portfolios that what kind of growth we can see over next 1 and 3 years?
So our expectation is that, I'd leave the corporate side for the moment because it is still work in progress and there's a lot of restructuring happening on the corporate side. On retail, I think we will step up from where we are at this point in time. We've done 25. We think that we should be in the 30-35 range as we go forward. We think commercial will come back. Right now it is at 9%. We've got our new products completely rolled out. The new risk screens are completely rolled out. And we should be growing commercial in the high teens, as well as agriculture. Agriculture is actually a seasonal business. So during the agricultural season, we expect to grow in the high teens again. So on average, even including corporate, our view in the near term is to, starting from the next year onwards, is to grow at roughly about 15% year on year. So that's the target that we've set ourselves, because we've now fixed the credit underwriting processes, pretty significantly, and we do think that we can step on the gas. Going forward, I think year 2 and year 3, obviously the intent would be to grow faster than that. We are in markets where the environment is conducive, and therefore we will try to go to the high teens. We are saying the first year in the mid-teens, next year into high teens or early 20+% is the ambition at this point in time.
Okay. Thank you very much, sir.
Thank you. The next question is from the line of Bhavik Dave from Reliance Mutual Fund. Please go ahead.
Hi, sir. Sir, just to continue with the previous participant, I just wanted to understand we are already at 21% NPA on our corporate book, which is extremely high, and we are still envisaging that another 1,250 odd crores will slip in this book, which will mean another 45% increase and a slippage rate, NPA rate of around 30-35%, which is even worse than a PSU bank. I would like to understand where is this 1,200 odd crores number that you're getting from? What sectors are these? Which are these big accounts that are under stress? Because the system is not seeing any increase in slippages on the corporate front. Even like PSU banks are talking of a slippage run rate that is decelerating from their highs. So I'm not able to comprehend where this increase is coming from.
So I think you misunderstood the numbers. We said that gross slippage on the corporate side, the expectations are roughly 750 crores, not 1,200 crores firstly. And I also said that we can visibly see roughly 400 crores worth of assets that are weak at this point in time. But, weakness arises over time, and I'm predicting 5 quarters out, so I've added another 350 crores as a buffer, okay? Assuming that something else will come up. So I have visibility to another 400 crores, and the rest is a guess estimate, if I may use that word, of future stresses based on which industry they are, etc., etc., etc. We also expect pretty substantial recoveries to come through. So on the net side, on the corporate front, we don't expect to grow more than 300 to 400 crores. I mean, even if the 750 crores happens, it won't be such a substantial growth. That's the expectation at this point in time. So does that clarify?
Yeah, and just on this 400 crores as well. So we had a watch list, we had a restructured book, we had these compartments that we had formalized. But even after that, when our watch list is completely over, what is this 400 crore that you're seeing? What sectors are these into, and what kind of accounts are these? Like lumpy accounts, or these are how many accounts would this 400 form? How many accounts would be there?
Okay, it's a good question. The 400 essentially, we had a watch list, yes, and the watch list excluded the restructured accounts that were there. Right. And the watch list was prepared with a view that we are looking 1 year out. I mean, the watch list cannot take into account 2 years out. Very difficult to predict. Right. That's point number 1. And the watch list held, by and large, as I explained in the beginning. The 400 crores that we're talking about are accounts largely in the engineering / construction space. The lumpy bits are there. And then there is an assortment of other accounts, which don't really have any particular pattern. But engineering / construction is the infrastructure, as you could say. So there are a couple of names there that we were unable to exit in time, and which have now turned south, delinquent, and are likely to be NPA fairly quickly.
Okay. And sir, secondly, on your operating expenses, so you've invested quite a bit on the revamping the way you're lending. So if I see the last 3-4 years, your cost growth has been pretty very, very stable at around 9 to 10% CAGR in the last 3 years, including FY19. So what would be your guesstimate for operating expense growth that you would envisage for the next couple of 2 to 3 years?
Look, this is one thing that we do quite well, manage our expenses. So even though this quarter, year-on-year, we've grown 14%, much of it is, one-timer provision for employee retirement benefits.
Sure.
I think we will not grow expenses by more than 8 to 10% a year, compounded.
Right.
We do have some room to rationalize costs further. Many of the expenses that we've taken to build out the new systems are at a point where they will be sort of spiraling downwards as opposed to increasing. And therefore, it gives us a little bit of room. And even if we want to do some stuff on the advertising front, which we've been, not really present in, other than on radio and so on and so forth, it gives us room to do more sales and advertising-related activity without growing expenses very dramatically. So we intend to keep expense control strong. We intend to grow the top line, and hopefully things will flow through. I mean, the only joker in the pack is how much NPA we accrete and how much provisions we need to make. But that is something that we are, very, very focused on.
And lastly, sir, the numbers that you spoke about during your introductory comment, where you said that 2,200 odd crores that you're expecting as operating profits, that is for 5 quarters, right? Not for FY20.
Correct.
Including the last quarter for this year and the next 4 quarters, right? That's how you're...
that may be an understatement. It may be a little bit higher. But I'm just keeping a reasonable number there.
Sure. All right. Okay. That's about it. Thank you, sir.
Thank you. The next question is from the line of MB Mahesh from Kotak. Please go ahead.
Hi, good afternoon, sir. Just again, coming back to the previous question again, if you look at slide 31, there is no mention of engineering and construction, which is that large. Why do you expect such a large slippage in this particular account? One. Second, if you look at again the SMA data, it is also not showing that kind of trends. But you're saying that it is likely to slip very quickly. Where are these stress sitting out there? And last quarter you mentioned that the non-fund based development, which is about 160 crores, which was sitting out there, the probability of default was was on the lower side. And we were kind of 30, 35 days into the results.
Mahesh.
Yeah.
On the contrary, I have very consistently said the probability of default is very high. You please read the transcripts again and do not put words in my mouth, Mahesh.
Okay, I'll take back those. I just thought that you said that, look, it is there sitting on the outside. And, I'm just using the words which are there. It says that it is not appropriate for us to make a provision at this point of time, given that many of them are performance-related guarantees, which may not be called ultimately. I think these were the words you had used in the previous quarter. So just trying to understand.
Subsequently, multiple times they've said that you should consider it as NPA going forward. I can pull it out. I can pull the transcript and give you. Okay?
No, we're not asking. We're not asking that. We're just saying that, look, it may slip into NPAs at some point of time. But last quarter there was some kind of a message saying that, look, it may not be called ultimately. So you would have had some kind of visibility that the probability that it will slip this quarter is reasonably low. But everything seems to have slipped this quarter. So just trying to understand what happened. Just trying to understand what was the backdrop behind this story. That's it.
Yeah, Mahesh, one account of 130 crores slipped. Okay? There are other accounts which did not slip. So the expectation was we didn't know when it would slip. It was a guarantee that got called, and we had to pay.
Fair point. And the fact that engineering and construction doesn't seem to be a top account when you look at the sector details, but you're expecting very high slippages, and it's also not in the SMA. It doesn't seem to be seen in the SMA 1 and 2, the early warning signals. But yet you're saying that it will slip immediately. So in the next 4-5 quarters, what is driving this visibility? Have I got dropped?
Sorry, I should have perhaps used the word infrastructure as opposed to engineering and construction. I mean, so that does feature, as you can see. We have 2,255 crores worth of loans to infrastructure. And this is a part of that.
Okay. And, okay. And you're saying this, and it's not seen in the early warning signals, but yet you're saying that it will default.
Mahesh, I have to make a prediction of some kind.
So we're just trying to understand that, look, no, the reason why we are asking this question is that, look, these numbers which you've put out in front of us today seems to be extremely high. It's kind of worrying us that, suddenly out of the blue you're saying that, look, you're going to see reasonably large slippages over the next 5 quarters at this point in the cycle. That's the whole reason.
Oh, Mahesh, I want to correct that. We've consistently said that if we can get down to 150 basis points of net slippage, we'll consider ourselves very happy. Okay? Our P&L can take it. We will make money at that point in time, just as long as we can ensure that we risk-based price and we ensure that our margins hold up and increase. Right? That's been the messaging all along. So even if I do 150 basis points in 5 quarters, it comes to about 1,000 crores. I am now saying my expectation is 1,100 crores and you are telling me it's very large.
No, sir, we are worried on the gross slippages, not on the net slippages. So just trying to understand what is driving
So there is gross slippage, there is net slippage. We are trying to give you more detail. See, ultimately what I'm going to hold myself to is the net slippage, right? So, I'm trying to, there's as much, this is a prediction. It has all the risks associated with any kind of prediction. But if the outcome is as close to what we got with the 1,200 crores, I'd be quite happy, actually.
5 points, sir. 5 points. Yeah, thanks a lot.
Thank you. The next question is from the line of Rakesh Kumar from Elara Capital. Please go ahead.
Hello. Hello.
Yeah, Rakesh.
Yeah. So, sir, just one question, firstly, on this security coverage. So, for Q2 presentation, we had, for more than 100%, secured coverage, of a higher amount, which has come down in this quarter. So, for this, where is the change? Has that account matured, gone out of the book?
Okay, there's been a... we'll have to come back to you as to what the reason for this change is. Approximately 2,000 crores seems to have moved out.
Correct.
Yeah.
Total is 28. It has moved.
So it seems the inter-bucket movement seems to be there. Is it because we've revalued those properties and those properties have become less valuable or more valuable? We'll have to figure out. But can we come back to you on this?
Sure, sir. And secondly, sir, in second quarter, we had given SMA 1 and 2 number of 1.8 or 1.3 or something, which changed, it got changed this quarter to 2.8. So what is the reason for the sudden change in the SMA 1 and 2 number just in 1 quarter? And with the slippage of around 900 crore.
Yeah, I'm aware of the fact that it has changed, which is what is prompting us to tell you that we are seeing a little bit, our expectation for immediate NPAs is a little higher than what we'd have liked. It's because of, the infrastructure accounts that we were talking about, that are not paying to term. So that's the reason why the delinquency numbers are a little higher.
So just one very small request, because of change in the number, could we request that, you can do the reassessment of the numbers from the NPL side, and we can do, some other time, we can give some better projections so that, we can also be more, confirmed and secured on that part.
In what way would you like us to...
whatever the projections we are giving, on the gross slippage, net slippage number, so we can do the reassessment and we can, give a number again maybe in the next quarter or maybe a month back, a month after or something like that.
Sure, we'd be happy to. I think we'd be happy to. We've had significant debate before we gave these numbers to you. This is the best number that we have. We'd be, as I repeated, if we get to 1,000 crores of net slippage during the next 5 quarters, we think that, we'd be in a reasonably good shape because we are generating enough to improve our provision coverage ratio reasonably quickly. The current view is that we'd be between 1100 and 1300. So that's the position. But we will give you a better outlook maybe a month or so down the road.
Thanks a lot, sir. Thanks. Many thanks, sir.
Thank you. The next question is from the line of Darpin Shah from HDFC Securities. Please go ahead.
Yes, sir. Thanks for the opportunity. So coming back to the GNPA or the numbers which you have mentioned, in commercial or the SME segment, you said 1,000 crore additional slippages over the next 5 quarters. If we see in our book, we already have a much higher number for that particular segment, say around almost 5.7, 5.8% GNPS. If you look, our closest competitor is sub 3%. So what is going wrong for us? And especially, when we have seen one big hit in Q1 of this year.
I'm trying to frame an answer that will be appropriate. So essentially, our NPA that we are holding at this point in time is 5.74%. Now that's a little elevated because we've not written off as aggressively as we should have, perhaps, some of these assets which we have been carrying for a long period of time. So since you track this share quite closely, you'll know that our write-offs are quite minimal on account of the fact that we don't have the P&L room to do so far. Going forward, we will manage the NPA a little bit differently. As we start accreting to our P&L more aggressively, we'll be able to do some write-offs so that we can clean up some of the older historical things that we are holding on the book. So that's point number one. So I don't know this entity that you're talking about in South India where their number is 3%, how much of such activities they've done, and therefore the comparability becomes a little difficult. That's number one. Number two, the 1,000 crores that we've estimated is based on a flow model. Okay? Flow models are reasonably predictive. Okay? I've not seen we have not gone account by account to figure out whether this will actually flow, not flow, etc. Right? The last time around when we predicted between 700 crores to, between 500 and 700 crores, so far the number has been is a little lower than the prediction last time around. So if you recall, in the first quarter, we had said, hey, we've got this blowout, we got 241 crores of NPA, and we said that we explained to you that the flow model indicates between 500 and 700. That's the best information we had at that point in time. So if this is anything to go by, then perhaps our 1,000 crores will not happen. Right? And that will be an outcome that we're very, very happy with.
Okay. Fair enough, sir. And the second thing, again on this commercial NPAs only. So the reported net NPA is almost 960 odd crores. Okay. And you're saying it's going to double in next 5 quarters. I know it is not comparable, but you're adding 1,000 crores. And even if I adjust for reductions of, say 300, 400 odd crores, still a 70-80% growth in that number, which we have seen over a period, will be added in next 5 quarters. So again, the same thing. You have
to remove the recoveries also, my friend.
So that's what I'm saying.
Remove the recoveries also,
Sir, if I remove, say,
you can't.
So 400 crores of recoveries if I remove.
Yeah.
Okay, net addition will be, say, 600 odd crores over the next 5 quarters. There is still a significant jump in next 5 quarters. If you see till date you have only 960 crores of an NPA, and in the next 5 quarters it will grow by 60% to, say, 1,600 odd crores. So
can you see our run rate for this year thus far? Can you see the run rate for this year thus far? We've accreted roughly 400 crores so far, a little over 400 crores.
Correct.
So it's not unexpected. I mean, look, my flow rates are not improving that much. That I agree with you. It's a given. It's granted.
And then, sir, still you are guiding for 1,000 crore of an addition Gross addition.
Gross.
That's what I'm saying, gross addition.
In 5 quarters, yes.
So any of the factors, the way you look at, has changed in this quarter compared to, say, previous quarters? Anything has changed there?
The factors that have changed is that, I think environmentally itself, there is stress that exists in the SME side. We are not alone in seeing this problem. Historically, our numbers have been very low. So we are a victim of success as opposed to failure. MSME segment, if you were to ask Sybil or somebody, will show you 15-17% NPA. We probably won't get there. I think the outcome will be better than what I have been sort of predicting. So far, if the flow model's indication is anything to go by. There are no specific, characteristics that we can see. There are certain industries and trades that we are avoiding, like schools, colleges, and so on and so forth. Otherwise, there is nothing specific that tells me you shouldn't do this or you should do that.
Okay, fair enough, sir. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir, thanks for the opportunity. Sir, most of the discussion has already happened around this corporate 750 odd crores slippages, expected slippages. Just sir, if you can provide some sort of anchor for your for you to arrive at this number. Is it BB and below book, or is it some sort of color? So let's say next quarter you have 200 odd crores slippages. That will help us differentiate that this so much amount has come from your earlier projected and so much is business as usual. Just a color on that would help, sir.
Ms. Mundra, we do have a reasonably sized chunk of entities that are proprietorships or partnerships, small businesses which are in the neighborhood of our business bank, where we have loans of 25 crores or thereabouts. Those, whenever you get them rated, even though the quality of the entity will be very, very good, the rating agencies, because the nature of the constitution of the entity, will give you a lower rating. So, with respect to the NPA projection going forward, majority of these, unfortunately, are bigger names that are in trouble. In one particular geography, okay, as I said earlier, I have visibility to roughly 400 crores worth of incremental NPA that's likely to happen. Okay, there visible signs of stress exist. There is one name that we have on the 5/25, which is part of the 750, which is in stress. But majority of these names are bigger names, so we don't have too many of these smaller names. In value terms, in number of accounts, when you all accumulate them, they will add up, but in number of accounts, they'll also be larger. But we don't see any trend. And one industry that we are seeing some stress in is this, people who are in the importation of wood, timber. So that's the one industry that we are seeing some signs of sustained stress on account of the fact that I think timber is dollar denominated. And most of these guys got caught out by the dollar rate movement. So they lasted as long as they can. And now they are showing some signs of stress because they've not been able to pass on the increased cost of the goods that they imported to their buyers.
But sir, actually I was asking more on the large corporate side, the 750 odd crores expectation. This will not include the 25 odd crores commercial trader kind of an account, right? So 750, as you said, of which 400 is very, let's say, near-term stress. So, I mean, and some of that you also said it is in infra/construction segment. So would you be able to quantify, sir, this 400 crores which we are seeing, this would be relatively 1 or 2 or 3 account, right? Is that understanding correct?
The 400 that you are seeing is 2 large accounts and 2 or 3 small accounts. Our definition of corporate is any loan over 25 crores or where the entity, a smaller loan where the entity has a consortium or has a turnover greater than 150 crores. So it is a definition which is different from that of the market. Consequently, we can have these smaller ticket loans coming through for entities that are slightly different type of entities than what you would normally see in a larger bank, for instance. So majority of these accounts on the infrastructure side are by definition larger entities, publicly known, where stress is building up, and we expect them to give us some trouble as we go forward.
Sure, sir. And sir, this risk-based audit exercise, has that been over for our bank?
Yes, it is over. However, the reports have not come.
Okay. And just last two things, sir. One is if you can explain the ARC sale, how much was the book value of the accounts, how much did you get in cash, and what was the write-off portion?
The total carrying value was 434 crores. Total cash recovered was in the order of magnitude of, just give me 1 minute.
Mr. Mutra, do you have any further questions?
So, we've just... approximate numbers. These are approximate numbers. I'll ask Mr. Shivaram Prasad to provide them to you if you should so desire. We sold roughly carrying value 434 crores, received approximately 140 crores in total.
And 140 crores, right?
Yes.
Sure, sir. And last question, sir, on this, sorry to come back again on this corporate stress. So you mentioned this 400 odd crores are in near-term stress. Safe to assume that they would have defaulted to other banks, right? Because you would have information on Krillek.
Yes, safe to admit that they have defaulted. Safe to assume that they have defaulted on other banks.
Sure, sir. Thanks very much and thanks for the time. Thanks.
Thank you. The next question is from the line of Dhaval Gada from DSP Mutual Fund. Please go ahead.
Yeah, sir, thanks for the follow-up again. So just a couple of more things. Sir, could you just give this 9-month period gross slippage for the commercial segment? I think a lot of discussion was around this segment. So just if you could help understand what is the trajectory that we've seen in commercial slippage in the first 9 months, gross.
Gross for the 9 months. Do you have the 9 months? I'll get you, Dhaval.
Okay, for the quarter, sir, in case you have it. What is the for the quarter?
For this quarter, it is 158 crores gross addition, and recovery and upgradation is 72.
Okay.
And net slippage is 86 crores.
Okay, sir. So I think the gross probably is around 400 odd, so first quarter was 261, this quarter is about 158, and last quarter was, I think, 80 or something. So is that sort of broadly?
I'll just tell you, Dhaval, I'll just call you and tell you.
Okay, no problem, sir. Just the other thing is, sir, on recoveries, how much are we budgeting from NCLT, sir? Because that would also help us on recoveries.
Can we sort of revert to you on that because we have to go through the names?
Sure, sir. No problem, sir. And just one last thing on growth, sir. In case we see that the credit loss is coming out to be slightly higher, in the sense that recoveries are delayed or slippage is coming out to be higher than what we anticipate, will we sort of look to pull back on growth? The reason I'm asking this is, I can see a need for capital at the end of next year, probably in the second half or fourth quarter. So just trying to understand, will we take first the precaution on balance sheet rather than going on growth? So just some thoughts around that.
Okay, we have some leverage on the growth side in the sense that currently our capital is about 14.6%. Most of it is tier 1. Okay. The risk weightage that we are carrying on some of our assets are such that we can, with some work, we can reduce the risk weights that we are carrying. So we think that we have some leeway on the capital side, but that requires some work, because we have to go back to our customers where they're unrated, we have to get them rated. where they are rated at a particular level, we have to incentivize them to bring in capital, etc., so that rating structures can improve. So currently, the carrying value that we have is higher than what we would like. So I think, we have some, as I said, ability to reduce risk-weighted assets with concerted action, which we've started doing as it is.
Correct.
So we've started looking at names that are, double B, for instance, which require 150% risk weight, and sort of working down those kind of lines. So that flexibility is a limited flexibility. It's not too much, but there is that limited flexibility that we do have. So we think that, yeah, go ahead.
No, I was just saying that when do you think you will need equity capital infusion, sir? In your budget plans, when is it that you need equity capital?
So in our plans, we need equity capital 2 years from now.
Okay, understood. And sir, the ESOP approval which was pending with RBI, has it been approved or it's still awaiting approval?
Which one?
There were some ESOPs that were allotted and were pending RBI's approval. Have that been done, or what's the status on that front?
The ESOP approval pending, ESOPs pending RBI approval are ESOPs pertaining to me.
Correct.
Unfortunately, there has been no movement on that so far.
Okay, sir. Okay, got it. Thank you so much, sir. All the best. Thank you.
Thank you. The next question is from the line of Akash Datani from HDFC Securities. Please go ahead.
Yeah, hi. Good evening. So most of my questions have been taken up by previous participants. So I just have a few data-related questions. So in this quarter, your capital adequacy ratio has gone up. I'm assuming that is because of a fall in the risk-weighted assets. Am I right?
Correct.
Hello?
That is right. Hello. Yes,
okay.
That is right.
Yeah. And so what would be the quantum of interest reversals in the quarter?
Quantum of interest reversals, ma'am, can I we've not disclosed it in the document. Can I just say that it was roughly twice of what it was in the prior quarter? So in spite of that, our NIMs went up by 3 basis points. So you could sort of estimate.
Fair enough. Okay. And my next question is regarding the exposure to the infra group. So I understand a certain portion of it is to the holding company, while the remaining is to the SPV/subsidiaries. So there has been a recent announcement by the NCLT or NCLAT regarding grouping of these exposures into green, amber, and red buckets. So where would the bank's exposures fall? In which bucket? Would you be able to tell us that?
Both of them, unfortunately, are in the red bucket.
Okay. And also, so there have been, my last question is regarding the MTM. So there have been write-backs this quarter of about 270, just a minute, of about 270 million?
Yeah, right.
Correct. Sorry, yeah. Yeah, and so there is still an amount that is to be amortized, right, from the first quarter. So I just wanted to understand how that would, what was the reason it wouldn't have been amortized in this quarter?
So we had a choice of either amortizing that and reducing the credit provisions that we were making.
Correct. The write-backs.
Disclosure, yes. So since we were allowed to amortize it by RBI, we decided to take the dispensation and provide more on the credit side. This quarter, we should have more room, and consequently, we should be able to amortize and take it forward. This was a conscious choice and a decision made, yeah?
Got it. Okay, so that's all from my side. Thank you for taking my questions.
Thank you.
Thank you. The next question is from the line of Yash Agarwal from JM Financial. Please go ahead.
Hello. Hello.
Yeah, go ahead.
Yeah, so just wanted to know the SMA 1 and 2 book for Q2 and Q3 in the commercial side. Hello.
Sorry, we've not been disclosing it thus far, but maybe starting next quarter, we will consider doing so. At this point in time, whilst I do have the number, I will, after discussion, we'll come back to you with those.
Some qualitative color, if you could, is it significantly higher in Q3 relative to Q2?
No, there is no significant growth in the Q1 and SMA1 and SMA2 number.
Okay.
And it's holding pretty much flat. So there is no reason to believe that they're deteriorating at this point in time.
Sure. And one more question. So, given the elevated slippages expected in the near term, what would be the net interest margin guidance? Would it be at this level? Would it be under pressure going ahead?
My own estimation is, and I've been saying this consistently, that we've implemented risk-based pricing. We believe we have pricing power. And our net interest margin this quarter has gone up by 3 basis points. We expect that increment to continue going forward. In fact, we believe that we will get slightly higher yields than what we are getting right now.
Okay.
And this increment happened in spite of the very large slippages that have happened this quarter. In spite of that, our net interest margin grew, and I think directionally it will continue to grow as we go forward.
And, you made the statement that if in the next 5 quarters, if you contain your net slippages to 1,000 crore number, you would be in a comfortable position. Earlier you made a comment about, hypothetically, the amount of provisions you could make, but would that get you near to the 1% ROA number by any chance if you contain your net slippages to 1,000 crores?
If I contain my net slippages to 1,000 crores, and I provide only what is required, let us say we provide only 600 crores, right, 600 crores. And if our PPOP is roughly 2,200 crores, then we have 1,600 crores. So you make 1,000 crores after, which is, yeah.
There would be some aging
provisions. For 5 quarters.
Yeah.
Right, what?
There would be some aging provisions, right, on the current NPA pool?
There may be, okay, we make 800 crores of provision, let us say, or 900 crores of provision. And we are providing now at almost 100% level. I mean, at 60% you will cover the aging provisions as well, normally.
Okay. Okay.
The question is, we probably will provide more than 60%. Let me be very honest. We want to do catch-up provisioning. Our provision coverage ratio is 41.5%. 41.7%, right? So we want that to edge upwards, go closer to 60 so that, we put this worry of the provisioning aspects behind. The yield drag that we are suffering on account of unfunded, non-accruing assets is reduced. The P&L will start looking much better. Right now, I have 2,000 crores worth of assets that are not earning anything, which is suppressing the yield on the total book. So our aim is to provide more aggressively. That in turn will have an impact on the ROA. So supposing it was 1,100 crores and we provide 1,100 crores or 1,200 crores, then your ROA will drop to that extent. I mean, but the aim is to provide more so that we can build this up and come to 60 for once and for all and then go forward.
Okay. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Abhinesh Vijayaraj from Spark Capital for closing comments.
Thank you, Stanford. On behalf of Spark Capital, I thank the investor community for dialing into today's call. I would also like to specifically thank KVB management team for taking time out and answering all our questions. Thank you.